how you're trying to make investing accessible and profitable for the average investor. Imagine you're about to lend rupees 10 lakh to a friend. Before handing over the money, what would you ask? Would you ask how fast his salary will grow over the next 5 years? Probably not. You'd ask a much simpler question. Will I get my money back? Well, that's exactly how bond investors think. And it's a mindset that every equity investor should borrow. Now, take the US listed Oracle Corporation for example. For months, investors were obsessed with one thing: AI. Every headline talked about AI infrastructure, cloud growth, and billion-dollar contracts. The stock kept climbing. But the bond market was asking a different question. How is Oracle paying for all this growth? The answer was simple: more debt. As borrowings increased and capital spending surged, rating agencies became concerned. Eventually, Oracle's credit rating was downgraded and the stock corrected sharply. The lesson: the bond market wasn't looking at the dream, it was looking at the risk. And that's exactly what equity investors should do. Now think about India. Remember Yes Bank? For years, investors focused on rapid loan growth and expanding profits. But bond investors were becoming increasingly uncomfortable with the bank's asset quality and its ability to absorb future losses. Eventually, reality caught up with the stock. Or take Vodafone Idea. Many shareholders kept hoping for a turnaround story. Bondholders were asking a different question: can this company actually meet its obligations? Those were the right questions. Even Reliance Communications looked like an exciting growth story at one point. But as debt piled up, lenders became increasingly nervous long before equity investors accepted what was happening. Notice the pattern. Shareholders often chase growth. Bondholders first assess survival. That's why Warren Buffett's first rule is don't lose money. It is also why Benjamin Graham insisted on a margin of safety. Those are not just value investing ideas, they are bond investing ideas. Before bondholders worry about returns, they worry about getting the principal back. Imagine if every time you analyze a stock, you asked yourself one simple question: if I had to lend this company money for the next 10 years, would I feel comfortable doing it? If the answer is no, why would you buy its shares? Because when you own a stock, you're still trusting the same business to generate cash, survive downturns, and create value over time. Growth is important, but growth financed by excessive debt can become dangerous. So the next time you're excited about an AI stock, a turnaround story, or the next multi-bagger, don't just read the annual report. Look at the balance sheet, study the debt, think like a bondholder first. You might not find every multi-bagger, but you'll probably avoid many disasters. And in investing, avoiding disasters is often what creates extraordinary long-term returns. Think about it. Well, that's all from me today. I'll see you again in the next session. Goodbye and happy investing.